Hello, my name is Lachlan St Clair and I'm the Principal here at CSP. I'd like to welcome you to the first edition of Smart Money for 2019. We trust you all had a great break over Christmas and New Year's and enjoyed time with your family. I know I certainly had a great time. I packed the kids and Kate in the caravan and we went over to Western Australia, which is a really long way away. But we had a fantastic time. The Nullarbor is an experience. If any of you haven't done that before, it's definitely something I think you should do. And in particular, the southern coast of Western Australia, so the area around Albany and Esperance, is just a beautiful part of Australia. We really enjoyed it. Then a bit of time at Margaret River at the end. Margaret River is fantastic. If you can do it without kids, it's a good thing because the wineries are fantastic, and unfortunately the kids don't get a lot of value out of that. So we're a little bit hamstrung in that sort of sense. But we must say the West Australian section was just fantastic. We had an absolute ball. But anyway, it's back to work. WA is obviously rapidly receding memory, and I suppose we'd like to take this opportunity to just outline our framework and our thoughts for the investment markets for the year ahead and the economy. So firstly to the economy, and I thought we'd start with the global economy. I suppose our views have become a little bit more cautious than they were at the end of last year, and there's really a couple of reasons for this. Firstly, if you have a look at some of the economic data, the PMI, which is the Purchasing Manufacturers Index, they're all starting to taper down at the moment for both the emerging market and the developed world. And that's a really good index for economic expansion. And when it gets below 50, that means we're moving into a contractionary phase in the global economy. And those numbers, they're still positive, they're above 50, but as you can see on the graph, the trends are pretty clear direction. One of the other things that we are concerned about, and I'll take a bit of time to explain this chart, is to do with the United States and the yield curve. And what the chart in front of you is showing you is the difference between the interest rate that people will pay the United States when they borrow for 10 years versus the interest rate they pay when they borrow for 2 years. And quite clearly, if you borrow money over a longer term, you want to be rewarded with a higher rate of interest because there's more risk, there's more time for things to go wrong. And so what this graph shows is the difference between the 10-year interest rate and the 2-year interest rate. And what you can see from this graph is every time that difference has come to zero or gone negative, it's been fairly closely followed by a recession in the United States. And as you can see from the graph at the moment, although we haven't actually gone to zero, the trend at the moment is pretty clear. And that leads us to being quite cautious, because if that gap closes any more, then it's going to go negative, and then indications are that a recession is not going to be too far away. So there are some concerns around the United States and the global economy with regard to PMIs. In addition, China's contracting at the moment, or contracting is the wrong word, it's growing at a much slower rate. The Chinese government put in a reasonably significant stimulus in the second half of last year, and that has slowed the rate of slowing, if I can sort of talk in the double derivative. But what it hasn't done is reverse it. So China looks like it's slowing down, and when you overlay that, obviously, with the problems in Europe, with Brexit and Italy, there's a lot of unknowns, I suppose, is the best way to put it, facing Europe. And the consequences for that on Australia are not insignificant, and particularly the trade war between China and the United States. If Xi Jinping decides to give Trump a win and promise to buy $200 million more of $200 billion more of something or whatever, that whatever is likely to be stuff that Australia currently sells to China. So soybeans or cotton or beef or whatever the case may be, it tends to be primary production stuff and may well come at Australia's expense. In addition to that, sort of the global economy, which, as I say, has got us reasonably cautious at the moment. And in addition to that, we've got the domestic economy in Australia. I wouldn't be telling anybody anything they don't know when I say that housing prices are coming off. And as you can see on this graph, there's not just words in the media. The property market has come off quite significantly. On top of that, the Reserve Bank has changed its language and its outlook with regards to interest rates. And it now looks as though the RBA is saying flat to a possible downward bias. One of the guys who I have a great deal of respect for on the bond market is calling a 50 to 75 point cut over the next 12 to 18 months. He thinks things are going to contract quite significantly. And a significant part of what's driving that contraction is the consumer. And so what happens is something called the wealth effect. When your house goes up in value, you feel wealthier. And when you feel wealthier, you buy stuff. Conversely, when your house falls in value, then you don't feel as wealthy and consumers tend to spend a little bit less. So that consumer spending, and this is one of the things the RBA mentioned in their last statement, that consumer spending starts to slow down, we could really start to see a slowdown in the domestic economy in Australia. So quite a few issues domestically that we have concerns about. Combine that with the slowdown in China, and obviously the effect that has on our exports, and the political uncertainty at the moment just means that from an economic perspective, we probably see more downside risk than we see upside risk at the moment, both domestically and globally. So if we then move to have a look at what the investment markets are telling us, what we can see at the moment is that markets still look reasonably overvalued, particularly in the United States. What we've got up at the moment is the Shiller PE index. Now, a lot of people don't like the Shiller PE index for a range of reasons. However, it does show to have a fairly close correlation with the US equity markets. And as you can see from this graph, although it's come back a little bit from its recent high, it's higher than it's ever been since the 1929 depression, with the exception of the dot-com bubble. So again, it's another red indicator to us. It's telling us just to be a little bit wary. In addition to that, the Farrelly's research has also got the United States S&P 500 in particular, showing a forecast return of around about 3% at the current S&P 500 levels. And again, it's just another red light on the board, I suppose. And none of these things individually say that a crash is going to happen or a recession's around the corner, but they do sort of certainly shout to us to be quite cautious. On the Australian market, the All Ordinaries where it is at the time of printing, we think the forecast return is sitting around 8% or so. So again, not a bad return through the cycle, but I think with those downside economic risks globally and domestically, it was kind of hard to mount a case at the moment to be overly aggressive, I think, in portfolios. Now, certainly from a portfolio construction level, over the course of the second half of last year, we took a fairly significant amount of risk out of most portfolios with clients. So we took a fair bit of money out of B3 and took some profit and put it back into B1. Now, I know there was some volatility in the second half of last year, and that made us look quite smart. But the reality is we didn't make that call due to an anticipation of that sort of market volatility. That call was really made off the back of the expected, those issues I was talking about before with the economy, and we are concerned that there's a potentially more significant pullback. So we're pretty happy with that conservative position at the moment. We certainly don't see anything around right now, subject to individual circumstances, of course, that would make us revisit that position. I think finally I'd like to make a comment on the Royal Commission. Obviously that came to its conclusion and Hayne delivered his report. And I must say that at a broad level, CSP, we broadly agree with his findings. Clearly the industry needs to go up and move away from things like grandfathered commissions. Whether the changes mooted for the broking industry are a good or bad thing remain to be seen. I do note the bank's share prices jumped 4 or 5% when the report came out. I don't think that was all short covering. That would be an inordinate amount of short covering. I do think the banks stand to win out of removing the brokers from the environment. But without getting into sort of too many specifics, I think I do broadly agree, I should say, with his recommendations. I suppose from a client perspective, it's important to say that I think we've been through the numbers and CSP is really well positioned to take advantage of the opportunities that present themselves off the back of this change in the industry. We've been a fee-for-service model for many years now, and really what we do is what they want, how they want advisors to behave. So I think we are really well positioned. The only downside is that there is going to be an increase in compliance costs for us, and there's just no getting away from that. And really the way for us to manage that increase in cost is through scale. So if any of you have any friends or colleagues that you think would benefit from our services, we'd really appreciate you passing on our details, because the more clients we can get on board, the more we can streamline some of those back-end compliant processes and not pass those costs through to clients. So that's it from me for this edition to Smart Money. We look forward to catching up with all of you shortly. And of course, if anything in this video podcast has tricked your mind or made you want to touch base with the office and just confirm your own portfolio, you're of course more than welcome to give us a call. We look forward to talking with you soon.